Welcome back to Markets Today. Today, we are hosting Faith Mwangi, who's a senior associate in the bank research team at Tellimer. We will be discussing bank valuations. I think there's been a lot of discussion on the rate caps and what that means for the budget. But we want to take a deep dive and understand, for you as an investor on the NSE, should you be buying banks today? Should you not be buying banks today? Faith, welcome to our show.
Thank you very much, Mbithe.
How's everything looking in terms of banks?
I think banks for now, it's a buyer's market, given that they're trading at very low prices at the moment.
Wow.
There's been a lot of negative sentiment in the market, so I think it is a buyer's market.
A buyer's market?
Yes.
Okay, interesting. What do you mean by a buyer's market? What is it?
Investors should be considering buying banks at the moment.
Okay.
I think the prices are very cheap. The last time we saw such prices was early in 2018.
Oh, wow.
Yes.
All right. And when you're looking at prices, are you looking at the actual absolute price, or are you focusing more on valuations and trying to forecast what people need to focus on 5 years out?
It's on valuation.
On valuation.
So if I look at the prices banks are trading at vis-a-vis the return that they're giving investors,
Okay.
I think they're very reasonable. If I look at the dividend yield especially, most banks are now at 7 to 9% dividend yield, which is pretty significant.
Okay. And what's the price to book?
On average, 1 times book value.
Wow. Wow. 1 times book for 7-8%.
Did you say 1 times
George,
book?
yes.
Yes, 1 times book value.
In fact, what has happened to banks? I mean, 2 years ago we were talking about 2 times book value. What happened over time?
There has been a lot of negative sentiment brought about by number one, the rate cap.
Yeah.
The rate cap saw ROEs come down significantly from just above 20%.
What was ROE in 2018?
ROE in 2018 was just about the 17% level, depending on which banks you're looking at. Tier 1 was closer to 20%. Tier 2 was about the 15 to 16% level.
Okay. Where are they now? Where the ROEs now?
What is the projection? I mean,
Yes.
what are you projecting this year, 2019?
For 2019, I expect Tier 1 banks to still deliver 20%. I don't think we'll see significant uptick in cost of risk like we did see in 2018.
Yeah.
I think that season is up. So we'll still see cost of risk remain high,
Yeah.
but I don't think we'll see the number that we saw last year.
But tell me, obviously, Mbithe mentioned about the rate caps. What you're feeling? Do you think MPs would shoot it down? What do you think? I mean,
I haven't gotten a sense that they actually want to remove the rate cap as is, but I do believe we'll actually see an adjustment in the loan rate cap as it is. So they're likely to have a higher ceiling. Again, remember just a few weeks ago, the IMF also released a working paper where they actually support, now support a higher ceiling on the loan rate cap. So I do think that will play a part in how MPs view this going forward.
I read the report, the IMF note. I don't agree with most of it, but it's okay.
At least you read.
But we'll discuss another day.
shall
But tell
discuss
me,
it.
tell me one thing. One of my biggest puzzles in the banking sector is a sustained uptick in loan non-performance.
Okay.
Where is it coming from? Because last year when I saw it was about 11%, I thought it was going to stop there. So we're going to see some flatness growth in NPL, industry gross NPL ratio. But we've actually seen a sustained growth in industry NPL ratio.
Actually, just
have you do some analysis? Where is it coming from?
If I may just add on to that question on the NPLs, if you can just give us a sense of what your projection is, and from what you've said, you expect a review of the ceiling. So what's the element? What does that mean in terms of your NPLs? Do they get adjusted? Do they get worse off? And by what percentage? So that if you're actually saying we should be buying banks at 1 times book with an 8% yield, what's the sense that you get if any adjustment is made to the risk, to the risk ceiling of the interest rate cap?
So my view is that we'll see NPLs remain where they are. I don't see any downward trend for NPLs going forward. Number one, we're still not seeing government spending in the economy, so there's not much money supply in the economy. Number two, we are not seeing manufacturing doing very well, so we are not seeing business growing. In terms of trade, we are seeing traders struggling, especially with the recent influx of imports. So that is also struggling. So there is different kind of struggle in different markets. So I don't see that improving, at least within this year.
So the Chinese impact actually has a consequence on NPLs?
Yes.
What is your current estimate on NPLs?
So NPLs, I still believe they'll still remain at above the 12% level.
12%.
You don't see 13% at the end of the year?
13% is possible.
It's possible.
So what I do not expect is a downward trend.
Okay, that's very scary.
Yes.
I'm selling all my bank stocks on that note.
Is it?
So in terms of my projections, I have accounted for that. So a higher NPL ratio as well as a higher cost of risk for all my banks.
Yeah. But tell me, Faith, IFRS 9, have you seen any impacts on balance sheets from your universe of coverage? Have you seen any significant impacts on IFRS some of I was looking at the equity bank's numbers and I saw almost 11 billion shillings impact on adoption of IFRS 9. Have you seen any similar quantum?
Is that 11 billion in addition to where they currently are, or is it in totality?
That was the total impact, because when they were migrating from, that's on day one adoption.
Yes.
The amount you pass through your balance sheet. So they passed through about 11 billion shillings. And I saw that weakened their balance sheet in Q4 last year. Have you seen any banks that have been destabilized by IFRS 9 adoption?
So most banks have between 5 and 10 billion. Again, if I look at specifically for equity, they needed to do that given that the coverage levels are significantly low, and most of their loans are actually SME loans. So that was expected. I think in Q2, they had already showed signs of inputting about 4 billion into their numbers. So that was actually expected.
Are you suggesting they've been understating risks? Or you're not saying that?
Not exactly, because they have security on that.
So let me get a sense of how you're valuing these banks. So you're saying NPLs 12-13%, and that doesn't change regardless of what happens to the rate cap. You're saying like we're already through the worst, if I get what you're saying. And then you're saying your cost of risk also remains muted. So for valuations of 1 times book, what's your cost of equity? What kind of return do you think is sufficient for you to actually undertake any risks that the Kenyan banks could take on? Is 20% something that would make sense for you in that market space, or what kind of cost of equity are you actually?
So cost of equity across all the banks is 17%.
Okay.
So for banks that are delivering between 19 and 20% ROE, I don't think they should be trading below book value.
All right.
Just on that. And even given that I have accommodated for a higher cost of risk,
then
I'm still seeing ROE being delivering 20%, especially for tier 1 banks.
Okay.
So with that in mind, I don't think they should be trading at 1 times book value.
And by tier 1 banks, you mean?
So that's KCB, Equity, Cooperative Bank.
Okay.
Yeah.
Which is your top pick from those 3?
KCB.
KCB.
Yes.
What's the valuation for that?
KCB, my valuations, I put it at 54.
Okay.
And it's currently trading at just about the 40 shillings level.
40
so I do
shillings
believe
level.
there's a lot of upside on that.
So we should, there's actually headroom from 40 to 54.
Yes.
And then the yield you have, the dividend yield you have on the bank?
So far it's about 7%.
7%.
Yeah.
So George, it seems it's probably better to buy these banks than to go buy our houses in
Molongo. 54 shillings. Market is trading at 40 shillings.
Yes.
Do you think the market is wrong?
Yes, I do think the market is wrong.
Oh, really? You don't think the market sees something that you're not seeing somewhere else?
What do you see, George?
Well, I think for me, first is on the balance sheet funding side, I think they've not gotten it right. There's a bit of a problem. And I see that part of the reason why they're acquiring NBK is for me, it's a pure liability game. I don't know how much uplift they can get from acquiring NBK in as far as liability is concerned.
Okay.
I think they're struggling with asset performance.
But George, if I may, when you're talking about NBK, do you have a sense, or have you carried out an analysis to get a sense of the element of dilution? So if we're saying, for instance, that you expect a 20% ROE, does NBK then erode that 20% to 17%? Because my guess is if it's only a 1% erosion, then it's neither here nor there. So then I wouldn't want to be selling out. But I don't know if we've done any analysis. I haven't done. I've just thought about it now to just get a sense of the extent of dilution, especially to your return as an investor.
But it's been a very interesting question, actually, Faith. Who's being diluted in NBK?
Yes.
From dilution on NBK, I think what we'll have from 2020 going forward is that we'll have KCB looking...
KCB. Hold that thought on KCB. We just want to take our viewers and alert you that the NSE trading has actually just commenced now at 9:30. If you haven't already put your bids in, you know what we were telling you to look out for. We're already telling you the tier 1 banks make sense. And we shall go on a short break, but look out for the market statistics that will be with you right now, and we'll see you shortly.